Okay, welcome to Lecture 5. And in this lecture, I'm just gonna talk. And there's gonna be a lot of concepts in here. So if you just open up your mind and listen, we're gonna cover a lot of stuff here. And we're gonna go through nuances uh, and some bar reading and profile reading and how to mark up charts and we're going to explain all of these things. So pay close attention. We're going to cover a lot and we're going to be like all over the place. So this is the purpose of this lecture is really to just open up your mind to market logic, and get you thinking right. So we can know how to look up charts. So I'm going to show you how I mark up my charts. And what I do is every day that there's a new point of control, I mark that with a line. And you can see this is just a little line that, I put on there so it extends right. And, I can see the points of control, long after they've gone to the left side of the chart. Here being a good example. So if I scroll back, I can see that this is a VPOC, a virgin point of control, a place where the market had balance and value and two-sided auction traded, and it hasn't been tested or checked yet. So I can scroll back and see that. So that's how I mark up my charts. And the reason I mark up my charts that way is because that's how the market works. And the market moves from balance to imbalance to back into balance. And so you can see here that happens on a daily level and also over many days and weeks. So you can see here, the market came down here in this A and B period, and then in the same day it moved back up into balance. Well, you'll get the same thing here on a much larger time frame. You had a point of control here, and the market moved up, and then 1, 2, 3 days later it came back down and tested that VPOC. See? So that's an example of the market moving from balance to imbalance, back into balance, and the importance of marking up the VPOCs. And once that VPOC is hit, I'll remove the line as the market progresses, and then I have new areas of value to consider where the market might move from one area of value to another. Okay? And so that's a concept there. And let's move on to some signals and clues that can give us areas to trade. And as an example, let's kind of look at like double tops and things like that. It's like you can see here is kind of a double top. And really, what is that? And how do we... And why is that called a poor high? And, what's the difference between a poor high and a poor low? Well, what's going on here is the market comes up and buyers are interested. And there's just no sellers at this level. And so the buyers just get out. So it leaves kind of just a double top called a poor high. So in market profile, that's called a poor high, on the daily thing. And as the bars or candles appear, it would appear as kind of a bearish engulfing or a double top. And the point I want to make here is the difference between a poor high and a good high is in this auction is what's going on behind the scenes. And in this auction process, you have buyers willing to buy higher, but there's no sellers for the buyers to buy from. And so the buyers just liquidate their position and they get out. And that means the sellers are lower, which you can obviously see here. You know, the market gap down and the sellers came in below value. Okay, so that's a poor high. And price is more likely to revisit a poor high sooner than it would a good high, and a good high being a selling tail. And the reason is its aggressiveness. So on a poor high, buyers are interested. There's no sellers there. Whereas with a selling tail or an excess bar, as it's called in market profile, it's aggressive selling. There were large sell orders there. So as price moved up, the large sell orders were there, and they just knock it down. And everybody knows that. And so it's less likely to return to that price or that selling tail very soon, because traders know there's a large seller there, and of course they don't want to get their heads chopped off. But when they do go test a selling tail or a good high, it's usually with smaller orders to test to see if that large seller is still there. Okay, and they'll use small orders because, I mean, you know, they just don't want to get killed. And if the sell orders are not coming in as they're testing it, then they can take out that selling tail or buying tail or that good high or good low. And you can see an example of a good high over here. Right here's a good high. You had big selling at the open on the A period. You know, that's the opening. And, you know, the market just goes down. And same here. You had these series of good highs, and it just really knocks the market down. As you can see, they're still going here until, great trade if you recognize it early. And we talked about the importance of the A period being that a strong opening, the A period, is indicative of large traders, have already decided to move the market directionally before the market even opened. So the market opened, and that's it. They just start selling the heck out of it. That's a good high, and a strong A period. And traders aren't going to trade against that. They're going to go with the flow. And so that's the difference. And you can see here, so that would be the difference. And we can see here we have a poor high and we have a VPOC, and the market is likely to come up and test these areas much sooner. And marking up your charts this way kind of leaves targets and can help you decide, which direction the market's going. And you can see here you had a strong A period down. You're below a VPOC. It doesn't test it, so it comes down and tests this one over here and takes it out. Okay? Now here's an example of, an intraday excess bar. And, to catch a good trade off of that is you need to know what follows. So if you get like an excess bar, what needs to follow after an excess bar, this one being, a little bit of a buying tail there in L period towards the end of the day, is one time framing. And because the excess bar is the end of one mini auction inside the daily auction and the beginning of another. So that's what you would need to see to take along. And what that would basically be would be you would get an excess bar. You would have to break the prior rotation by 2 ticks to start one time framing, and then you may be able to verify that the mini auction has changed direction and then go in the same direction of it. Okay. Here's an example of some one time framing, and you start. What happens is, you get the strong A period, and you break it in B period. You break the high of A period and B period in the market one time frames, and you have anomalies here that it's made, and so you see the next day it comes back to fill in these anomalies in the profile, and one of the reasons is. Okay, as an example, this would be like a pullback low, okay? So you get the excess bar, and if you break by 2 ticks and you get one time framing, you can, go with the trade. And then you see here, the market pulls back a little bit midday. That's your pullback low, and you see the next day in A period, when it gets below the pullback low, you can get a nice little short there, okay? Because all of the, those buyers would be trapped, but they came back in and pushed it back up. Okay. So that's the importance of looking at the one time framing. And you can trade kind of like short-term traders or scalpers, floor traders. What they do is they just trade rotation to rotation. And they'll look for, the break of the high of one rotation against, the prior rotation and want to take along. As you can see here, you had the one time framing starting, and, you see it pulls back on you here. It never gets below this rotation, and so, they're going with it. And so that's another thing to look at. And then to get into the, this Gaussian distribution, and you can see the different shapes of the profile here, you have good Gaussian distribution here. Price crossed through this VPOC many times. There's that is, an interest in price there. And once it gets above it, the next day it opens up and it just goes. Because traders established this area of value the prior day. It's a good area of support, and then they just push it up. Okay, so then you see you get a pullback in to fix some of these anomalies. This is, would be basically just a sloppy profile as they pushed it up. One time framing breaks easy because there's no support under it. It's just, aggressive buying, and then it tries to repair or fill in the Gaussian distributions. And what's important about that is, this is a daily, weekly, and a monthly, and you can see here is, a good Gaussian distribution or high volume nodes in your volume profile shows price interest. The market's making value there, it's happy, two-sided trading takes place, and price won't really move on until all of the shares, at that price level are exhausted, and makes a good Gaussian distribution. It's price interest. Traders are interested in this price levels until they're all exhausted, and then it moves to fill in low volume nodes or anomalies in your market profile. And you can see here from this 1885 up to here to this 3950, is lower volume nodes, and you can see that price moved up to, you know, complete this Gaussian distribution. And you can see that here. Here's a good Gaussian distribution, from 2 weeks ago. And then price moves up above this distribution and tries to fill in all these unfilled orders here and begins to make a nice Gaussian distribution up here in these levels. See? So you get there's price interest here, there's price interest here, and it'll eventually move to fill in this 1912.50 area to make a nice distribution there. Okay, so that's and you can see that on a daily basis and larger time frame, weekly, and then monthly. So even the rest of this month, as long as we stay above this distribution area, you're going to trade within this area. And, you'll probably get up here to this 2250, which brings us back to, what is the market trying to do? And you can see here, we up at this 2575, we have an untouched VPOC, and we have one here. So, if the market starts getting up here above this retrace high, it gives you trading levels and targets to shoot for, highs of days and the VPOCs. Then we know the market's going to try to move back into balance into this 1907 and 1925.75 area. And that's the importance of marking up your charts and analyzing your profile, noticing where your Gaussian distributions are, and where they are not if you have a sloppy profile, because markets can be inefficient. They would have to go in and repair that, do profile repair. And then you'll probably come up and revisit this poor high, see? Which gives, so you've got, an area here and targets, that you're looking for, that, gives you a good idea of where the market's headed and why the market is headed there. Okay? So, that's what you do, is you mark up your charts, get your areas of value, get a good read on your profile, look for your areas of value, and that's how the market works. It's going to trade from one area of value to another. It's there because of price interest, facilitating the two-way auction, and those kind of things. So I hope this puts some concepts together for you and helps you to think in a market logic way, and notice these importance of a period, the buying tails, the selling tails on a daily profile, and on the mini auctions, the 30-minute, excess bars, and weekly and monthly balances, 3 and 5 day balances, interest, poor highs and poor lows, and they help you make a good, conscientious trading decision. And even if they don't, if they can keep you out of bad trades, that's going to put you ahead too. So I hope you've enjoyed these lectures. I hope they were insightful for you and help you improve your trading. And I'd like to thank you for your time. And it's pretty heartfelt. I'm trying to you know give you good information, and hopefully it'll improve your trading. So thank you so much for your time. Uh, Please feel free to go back and revisit these lectures uh, and develop a quality market logic. Thank you.